like a minute before we start.
Perfect.
Okay.
We are now live, so hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your Money Show host for this session. I do have Austin here with me in the Zoom room, and we are ready to begin his presentation on time at 1 p.m. That's Eastern time, coming up again in just a few short minutes. If you're looking for something to do while you wait, please feel free to check out Stansberry Asset Management's virtual booth. They do have some information above the video player, as well as handouts and a way to request more information below. There are actually quite a few handouts in this virtual booth today, so please feel free to take some time, check those out, download them if you are interested. Thank you everyone for your patience, and once again, we'll be getting started in just a few minutes. To everyone just joining, hello, welcome in. We will be getting started on time at 1 o'clock p.m. Eastern time, coming up in just a couple of minutes now. Thank you all so much for your patience. And please feel free to check out Stansberry Asset Management's virtual booth below the video player if you're looking for something to do while you wait. Hello, everyone, and welcome to the session. It's my pleasure to introduce Austin Root. He's the Chief Investment Officer over at Stansberry Asset Management, where he oversees the investment strategy across the firm's portfolios. And he previously served as Director of Research with Stanbury Research and has founded North Oak Capital. Now, to our live viewers, if you have questions for Austin throughout the session today, please feel free to share them in the live chat box. It's located on the right side of the video player. Time permitting, we'll see if we can get to some of those questions at the end. And with that said, Austin, I will hand the mic over to you. I'll be here if you need me, but the floor is all yours.
Fantastic. Thanks very much. And yes, hello and welcome to you at viewing this presentation. I am Austin Root, Chief Investment Officer at Stansberry Asset Management. And on behalf of all of us at SAM, thank you for attending and viewing this. I might be biased here, but I think we're going to make great use of your time. I think it's a very important topic, which is, should I be using alternative investments and alternative assets in my investing? And if so, how do I do that? How do I optimize that? And we believe that there are four key steps that are mission critical to make sure that you optimize alts investing. But before we start there, I think that the main question is why? Why ought investors and individual investors add alts to their investing? Institutional investors have long decided to allocate to alts. And, I think the main reason that the institutional investors have done that and why we think individual investors ought to is simple: better risk adjusted returns, specifically higher returns over the long run relative to the total risk that you're taking in your portfolio. Now, you may have seen this chart, Efficient Frontier chart, over the years. This is a chart without alts in it to start. On the x-axis, the horizontal axis is annualized volatility of a portfolio. And then the y-axis, the up and down, is the annualized returns. And this is with varying levels of the traditional equities and fixed income. That boilerplate 60-40, 60% equities, 40% fixed income is there and the orange dot in the middle. Now, when we add alternatives to the mix, a wonderful thing happens. We move that efficient frontier up and to the left or to the northwest quadrant. We like to call this northwest investing. It's fantastic because you are, by going upstream, you're increasing your annualized average returns. By moving it to the west or left, you're also then reducing your volatility. I think the next question many investors ask is, well, how exactly is that? How does adding alts improve your returns relative to your risk? And it's a longer conversation, but we're going to boil it down into two things. First, the illiquidity bargain. To do alternative investing right, you are giving up a very valuable attribute for part of your capital, and that is liquidity. Said differently, if you had two investments that you could invest in and they both delivered a same 10% return, one was illiquid for 3 or 4 years and the other one was perfectly liquid, you could get in and out anytime you want. Well, of course, we would all choose the liquid return investment. So said differently, alternatives, by nature of being illiquid, the right ones are illiquid. We'll talk about that a little later. But by virtue of committing your capital to a certain amount of time, they have to produce a higher return, all else equal, to be attractive at all. And that's really what we've seen over time, that the illiquid assets, both on the equities and fixed income side, have generated outsized returns. Now, liquidity is a valuable attribute, like I said, so you can't be alternative in illiquid assets for your entire portfolio. But for a portion of your portfolio, depending on your own unique investment attributes, if you can be illiquid for part of it, it will improve your returns. The other piece of this, that why alts can can improve your returns relative to risk, is they're actually broadening your investment base and at the same time lowering the overall correlation of your total portfolio of assets. I like to ask my clients, for the first time, until they've heard me say this before, what percentage of large companies, those companies with $100 million in revenues or more, would you guess are publicly traded? And typical answer is maybe 50 to 60%, recognizing that the private market is relatively large, but most large companies are probably already public. The answer actually is only 13% of companies in the US with revenues greater than $100 million are publicly traded. So you can broaden your investment base when you start investing in non-traded alternative assets, equities, credit, and the like. And so we really think that's an impactful thing, and it's a value add to a portfolio when not everything is moving in the same way. We've seen in many instances alternative assets not move and actually hold their value when publicly traded bonds and stocks are going down, as they did in 2022, for example. So, with that, what are the 4 steps we think are mission critical as you seek to optimize your own alternative investing? Step one, do the do. And this is not Mountain Dew. This is due diligence. Due diligence absolutely matters. Put the work in to find the right alternative investment managers making the right kind of alternative investments. Now, that may seem self-evident. You're probably doing that same due diligence on the public market side, but it is so much more important to do that on the private markets. Why? Well, the variability in returns or the dispersion in returns is so much greater in the private markets or the alts world than in publicly traded assets. This is a busy chart, but let me just focus on two parts. First, if you look at the dark blue dots, those are fixed income dots, government, municipal, corporate. If you can see that at the bottom, they are not generating a very high return. Return is over the x-axis here. But the dispersion measure, which is really comparing the top quartile of managers relative to the bottom quartile, how far away are their return profiles? The dispersion measure is very low in fixed income. It's actually, frankly, very low in public equities. If you look at those light blue dots there at the bottom, US small cap equities, US large cap equities. In other words, the amplitude of difference between the very good managers and the very bad managers is pretty tight. But let's look at the topmost dot here on this chart. That's venture capital. So venture capital is an example of an area where they are seeking very high returns, but the amplitude, the difference, the dispersion measure between the very good alts managers and the very bad alts managers is enormous. It could be the difference between making money and losing money. In fact, it is over time since 1990. The bottom quartile of venture capital managers have lost money, and the top quartile have made you a lot of money, and the top decile have made you a lot of money on top of that. So do the due diligence to make sure you're feeling confident that you're in with a good manager. But that's only step one. Step two is you might be wrong. So please diversify your alternative asset ownership. Never own just one alternative asset. Do not put all your alts eggs into one basket. I want to show this chart that Howard Marks created, and I think it's maybe even a better picture of what I had on the previous slide. This is the typical efficient frontier you've seen in textbooks, finance textbooks, where return is on the x-axis, risk is on the y-axis, risk is on the x-axis. It kind of belies the point, because if you just think, well, gosh, if I'm going to maximize my return, I ought to just take more risk. He hates that notion. And this is the chart that he created, which is to say, in his words, while the expected return rises along with risk, so does the probability of lower returns and even losses. That's what we're saying here. So I want to take points 1 and 2 together, which is to say, investment selection, manager selection matters, mission critical. and diversification matters. Even if you pick the right investment manager, they may have a bad fund or a bad series of investments. So doing these two things together in tandem are super important in any type of investing, but they're mission critical when it comes to alternative asset investing. Step three, we need to embrace seasonality. We at Stansberry Asset Management say that all investing is seasonal. You do not need to be invested in all kinds of assets all the time. There will be winters for many types of investments. And look, it just pays to avoid them during those long, periods. This is our outlook on the current seasonal conditions for alternative assets. Across basically every asset class, we do have relatively high asset prices. If you're not SpaceX or OpenAI or maybe a couple of other of the AI hyperscalers, the IPO window is actually mostly closed for most investments. We have tight lending standards from banks, relatively high interest rates, and taking those two together, the spreads to be a borrower are very high. So you have high prevailing interest rates and then very tight lending standards. So rates are up. And then importantly, we've got a lot of dry powder. Private equity firms and venture capital firms have raised a lot of capital in the last few years, have not yet deployed that raised capital. So taken in aggregate, we do not feel that the conditions favor allocating any new capital to private equity or venture capital. In our eyes, instead, in the current environment, it's far better to be a lender rather than a borrower. And private equity investors, by and large, are borrowers, and even venture capital firms are relying on borrowers to eventually in their exit. So the best alternative asset today is to become a lender. So when we're thinking back of adding alts to our portfolio, to that 60/40 portfolio, rather than thinking about upgrading the 60, we should use alts in this current season to upgrade the 40 in our portfolio, generate better income and total returns than you can in the public bond market, with more ballast, less correlation. Becoming a lender, I'll explain that more, will have a lower correlation in the private markets than it will in the public markets. And really, in totality, do a better job of what publicly traded fixed income is supposed to do. So despite some of the headlines to the contrary, we believe this is a very good season for private credit. That's right, private credit. But I want to make sure I caution one thing, and that is step number 4. We do not want to stretch too far within private credit. If your capital is utilizing some combination of these no investment factors, we are concerned and we do see problems ahead. So let's go through these to make sure we don't, as private credit investors, we're not stretching too far. Let's take the bottom two first, because those are most easily understood and obvious. Too much leverage. Well, let's start weak collateral. We do not want to invest, even if it's secured debt, against weak collateral. Some of the folks that have done private credit towards software as a service companies where they don't have a strong core value proposition are very concerned that their collateral is not that strong, for example. We also do not want to utilize too much leverage. Private credit and direct lending in particular works great when you're senior secured, but when you're junior or when you've lent 90% loan to value, you've just inverted the whole attraction of private credit. In our views, private credit done well provides equity-like return at credit-like risk. If you have weak collateral, or if you have too much leverage, or if you're junior in the cap structure, you've inverted that, and you are at risk of getting credit-like returns at equity-like risk. So we don't want to do either of those two things. Now, what do I mean by duration mismatch? Well, this is what's been in the headlines lately. with some of these business development companies or interval funds that promise semi-liquid offerings to investors in which they say, look, you can have quarterly liquidity if you need it. The fine red print, though, is quarterly liquidity up to a limit. And in many times, that limit is only 5% of total assets of the fund. So, in other words, they're investing in assets. And so the assets in the fund are long-lived assets. Maybe they're 5, 10 year long-lived assets. And yet their liabilities, they're promising short-term liquidity. So you can imagine what kind of a challenge that is. If everyone is running for the exits at the same time, taken to its extreme, if you want out, you can only get 5% of your capital out. So we want you to avoid all three of these things. Bad outcomes can happen. However, if you avoid these three things, our outlook on private credit, particularly given some of the negative headlines, is extremely favorable right now. So we believe this is the right time for the right kind of private credit. We are going to largely avoid this stack of things, and we have with our investing on behalf of our clients and ourselves. We don't want to be in the junior and unsecured debt. We don't want to be in those semi-liquid or interval funds that have duration mismatches. We actually don't want to be junior debt providing capital to private equity sponsored deals or competitive bidding deals. The return profile relative to the risk is suboptimal there. The larger deals also don't look as good. And frankly, we don't want to invest with managers who are so large that their goal is just to deploy as much capital as possible. In fact, in each of these vectors, we want to do the opposite. We want to be senior secured. We want to have aligned duration with our assets and our liabilities. We want to avoid those competitive deals where we can provide niche strategic capital. We can be the fulcrum security in that stack. Actually, we look at deals where they can take our capital in lieu of doing a private equity buyout. And finally, most importantly, we want to align with a manager that wants what we want, which is high internal rates of return on our capital. Now, before I get into specifics on how we're doing that right now, let me give you a little backstory or history on us. SAM is celebrating its 10-year anniversary this year. We've grown to north of $1.3 billion. We started as an investment manager with a couple of strategies. We've broadened what we offer to clients. We provide holistic financial plans with really dedicated, fantastic wealth managers. So, you have something that really every investment offering manager should have. You have a dedicated active investment management team sitting right alongside a dedicated wealth management team, and you get both when you become a client with SAM. No additional fees. We just one fee for giving both those services. We have added alts. So many of our clients would benefit and have benefited from adding alternative investments. And what we did with Fund One was exactly what I'm talking about. We did lots of deep due diligence to identify 5 world-class managers where we could provide strategic capital to them. In most of these cases, we got a discounted fee for bringing them new clients. We commingled all of our clients into one LP on behalf and invested with really great managers. We diversified importantly, like we talked about. These best of breed managers are focused on providing strategic capital in middle market or even small market deals. It is going well. We've deployed most of the capital at this point. We are now sending out this is a closed fund, sending out distributions on a quarterly basis at just south of an annualized 12% rate. Our NAV continues to grow on top of that, and so we're anticipating strong total returns and IRRs for our clients as we continue with this fund. We did the same thing for retirement capital, so non-taxable or tax-advantaged qualified assets and IRAs, and really same running it back. That fund is newer in terms of when we closed. but we're ramping up the capital and ramping up the distributions. Now, I will point you to one of the managers that we looked at, Benefit Street Partners, or that we are allocated to. They focused on a different asset class than the rest. The rest were really focused on senior direct lending to healthy, durable, high quality businesses. We still love that type of direct lending. But currently, we favor investing in a asset class that Benefit Street Partners was doing, taking advantage of what we believe has been over time one of the most stable asset classes in the world, persistently over time, driven in large part, to a multi-decade imbalance between demand of this asset and supply of this asset. In other words, we favor investing in secured debt backed by residential real estate. Now, why does this steadiness and this our attraction to this market and this asset class persist? Well, it's because of the persistent outstripping of demand relative to supply for new housing. So household formation has continued over the past 2 decades, really pre-GFC. It was that way as well. Strong household growth, but not nearly as strong of new housing construction or housing supply. So that imbalance, in our eyes, generates a really sound asset base against which to lend. We're not projecting house appreciation of any material magnitude beyond inflation, although it could, given this gap in supply versus demand. However, we are projecting that it will be stable and should not decline given this gap. If anything, we expect interest rates to come down, which will only support this asset base. So we like secured debt backed by residential real estate. There are favorable credit merits on this type of thing. We think the fundamentals are strong. We like investing senior secured with low loans to value. We believe that real estate acts as an inflation hedge. Again, we focus on that first lien area, but importantly, where banks are not. If banks are happily lending to a certain type of residential real estate, the return profile is weaker in that, and we avoid that. But given the GFC, the global financial crisis, and the way that banks were forced to recognize certain types of loans differently on risk-weighted basis, and frankly, the KYC and due diligence on all the things that they have to do. There are many parts in the residential real estate lending market where they can't play. They can't be nimble. They can't be flexible. The capital that they have to allocate towards it makes it prohibitively expensive. They can't get an answer quick enough for the borrower. Those are the areas where we're focused. Taken together, all of these things mean that private real estate assets have generally been lower correlation. Remember, that's what we're trying to find as we look at your overall total investment portfolio. We want to own some assets that do not correlate with the rest of the public market to provide us more ballast and stability when we generate strong returns. Here's what we're really trying to do, and this is how we're doing it in a nutshell. We're seeking to identify inefficiencies in the lending market and try to benefit from structural advantages over traditional lenders. How do we do that? Well, we've partnered with one of the largest mortgage brokers to produce a sourcing advantage. Simply, this sourcing advantage requires no marketing spend to provide these sources of borrowers seeking capital. This mortgage broker, probably 90% of what they see on a daily basis, will go out of what they actually accept as acceptable borrowers, will be farmed out to one of the traditional lenders. Maybe it's Fannie or Freddie, maybe it's one of the traditional banks. But a 10%, more than $1 billion of flow, are to borrowers that may be solid, sound borrowers, but it's non-traditional. And those are really the types of situations where we're looking for, where we can still generate strong returns, but having excellent credit profiles, low loans to values with strong collateral, which we think the collateral basis is steady. We're looking at 53% average loans to value. We have an experienced leadership and investment team, not only for us, but also our partners. Again, zero marketing expense to acquire these new deals. These are internally sourced deals. Huge advantage, by the way. We can cherry pick the best deals. And again, this is a key differentiator versus the very slow and sluggish banks. We can be speedy and flexible. I'll give a couple of examples of what we're looking at. This is a kind of a garden variety fix and flip financing where a house needed to be fixed up to be able to then be either sold or rented out. And at a low loan to value, 53%, a reasonable interest rate of around 12%, you can generate mid-teens returns when you do this over time. Why? Well, the origination fees are strong. If the borrower takes longer than the short-term duration, you can generate more fees. There are oftentimes closing fees. And really the way to generate this is to continue to recycle the capital into that next deal. The current market is really closer to a 13.5% prevailing interest rate. Oftentimes these are floating, so you have the benefit of a little bit of security if interest rates move up or down. With floors, though, if they come down too much, a lot of times we have a floor in there. But here's the key. The borrower successfully wants to, they're incented to refi us out because then they can, once the property is stabilized, get a much lower rate. So if you do these on a one-off basis, you can generate good returns on your capital for the short period of time. The average loan is between 9 and 12 months. But where you really generate the returns is if you have a steady flow of these deals that you can reinvest and reinvest. Another example of a type of bridge loan that we look to provide is something where this is actually a real estate investor that saw a great opportunity to buy another property, needed to close right away in order to access that property and that investment opportunity. Bank couldn't get it done in the time, but this is an example of something where it only took 4 days to close from the time that they came to us till the end, 4 days. And so that speed, now it was only a 15% loan to value. We felt comfortable with the collateral, but that's an example of the type of thing that we're looking to do. What are the core areas of investment we're looking for? It's really the senior secured piece that's going to be the vast majority of this of what we're looking to do. There will be certain parts of the cap structure where we're willing to go a little deeper when we have favorable economics. If you think about a multifamily, which is still within residential or senior housing, those things are more readily bankable. So sometimes generate the stronger returns. The fulcrum security is not the senior debt, but it might be the mezzanine debt. And oftentimes we may have some warrants or success fees attached that would bring us down into the common equity. But really the bulk of what we're focused on is that senior secured debt. How are we doing this? So we will have those LP interests investing alongside core managers. But because of our strategic positioning, we will also be doing co-investments alongside these investment managers where we have full discretion and importantly, much lower fees on these things. In multiple examples, there's no management fee on it. And so we want to pass that on to our clients. So in addition to that, we are looking to do direct investments directly from Stansberry Asset Management and our expertise. And then there are opportunities to actually partner with a GP, with the general partner, and share in the economics with our investors, some of those great fee participation opportunities. Now, I want to come back here full circle and think about these four steps. Um, a fifth one, or if I say four and a half, is we need to make sure that the investment works for you. Now, these are, and this is the type of investments that we provide for our clients. And we believe every investor has just some combination of just three goals. They want to maintain their wealth, generate income, or grow their wealth. We have a holistic approach to do that for you. Please reach out to us, and we'd be happy to share that with you.
Thank you so much, Austin. Now we are out of time, but I'm going to squeeze in one quick question here, if that's
Yeah.
okay.
Yeah.
Betty had asked, do any of your investments qualify for a 1031 exchange?
So 1031 exchanges, not in this particular strategy. It's a great way to provide if you have an asset that you're looking to shield a little bit of tax treatment on, then it's nice to do that. That's generally speaking going to be more on real estate equities versus what we're looking to do. So not in this fund, but it's a great question, and really it begs the question. And our point is tax treatment and tax focus is a really important part of when you're investing, and tax planning is something that we offer.
Fantastic, Austin. Well, thank you so much again for a wonderful presentation. It's always a pleasure having you join us at these virtual expos. And to our live viewers, thank you for tuning in, and be sure to stay tuned as we have more in store for you in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.
Thank you.